Welcome to the deep dive. Looks like we're diving into the world of Benjamin Graham today.
The OG of value investing.
Exactly. We've got a whole stack of your sources here.
Awesome.
We're going to break them down, pull out the good stuff,
All right.
so you can use it whether you're a beginner or, you've been doing this for a while.
Yeah, and from what I see here, we're going to be covering the classic investing principles.
Oh, yeah.
And some stories about market bubbles, manias,
Oh, wow.
how to avoid getting caught up and all that.
Love that. Avoiding the hype and focusing on what matters.
For sure.
Okay, so the first thing that jumps out from these sources is how Graham categorizes investors.
Interesting.
He talks about defensive and aggressive approaches. Can you expand on that a bit?
Yeah, so Graham's concept here is all about figuring out your own investing style.
Okay.
So defensive investors, they're the ones who want safety and simplicity.
Got it.
They don't want to spend hours looking at, financial statements.
Yeah.
They want steady returns without all the stress.
So more of a set it and forget it type of thing.
Exactly. Think index funds,
Okay.
blue chip stocks, maybe some funds.
Yeah.
They're not trying to beat the market. They're just trying to keep up with it with the least stress possible.
And on the other side, you've got the aggressive investor,
Right?
the one who's ready to get their hands dirty.
Yeah, exactly.
Beat a little deeper.
These are the ones that Graham calls enterprising investors.
Oh.
They're looking for those undervalued opportunities,
The hidden gems.
Exactly. They don't mind putting in the time to research companies,
Oh, yeah.
analyze financials, try to do better than the market.
So wouldn't that require, a lot of expertise?
That's a great question.
Because, I'm interested in investing,
Right.
but I don't have an MBA or anything.
That's a really good point. And Graham actually talks about that.
Okay.
He says that to be an enterprising investor, you don't have to be like a Wall Street whiz.
Right.
It's more about your mindset, having the patience to learn and being willing to think for yourself.
So it's not about, knowing all the answers. It's about
Yeah,
asking the right questions.
absolutely.
I like that.
And what's interesting is that Graham's really against trying to be in between these two.
Really?
Yeah, he says it's like being a half businessman.
Oh, okay.
You're not fully committed either way,
Yeah.
and you're probably not going to get the results you want.
You're stuck in limbo.
Yeah,
Makes sense. Pick a lane and commit to it.
for sure.
So for someone leaning towards that aggressive, enterprising approach,
Right.
what's the next key takeaway from Graham?
It kind of goes hand in hand with what we were just talking about,
Okay.
finding those undervalued securities.
Got it.
Graham was really into what he called secondary common stocks.
Okay.
Basically, stocks of smaller, less talked about companies.
So not like Apple or Amazon.
Right.
Okay.
And here's the cool part.
Right.
Graham thought these companies could be just as good, maybe even better than the big names,
And why is that?
because they often get overlooked.
Oh, interesting.
Most investors are more on the defensive side, remember?
Right, right.
So you have this whole pool of companies that could be undervalued.
That people aren't paying attention to.
Exactly. And our sources even talk about how these companies
Yeah.
often get bought out at way higher prices than what their stock was trading at for years.
Wow.
Like finding a hidden treasure at a flea market.
That's a great analogy.
So you're thinking, how do you find these gems?
Yeah. How do you even begin?
That's where Graham's principles come in.
Okay.
It's not about chasing hot tips or trends.
Right.
It's about having a system for figuring out what a business is actually worth.
Got it.
Like their financial health, their long-term potential.
Makes sense.
We'll dig into those principles more as we go, but
Yeah.
based on what we've talked about so far, anything standing out to you?
Let me think.
Anything making you rethink your own investing?
What's really striking me is how Graham emphasizes knowing yourself as an investor.
Yeah.
Before you even think about picking a stock,
Right.
you got to pick a philosophy.
Sure.
Am I more like the patient defensive type,
Right.
or am I ready to be this enterprising investor Graham's talking about?
You got it.
That's really resonating with me.
Yeah, it's all about self-awareness. And as we keep going through these sources,
Okay.
you'll see that theme come up again and again.
Got it.
Because Graham isn't just teaching us how to, analyze companies.
Right.
He's teaching us how to analyze ourselves,
Yeah, that makes sense.
as investors.
Okay, so you've figured out your investing style.
Right.
What's next?
Let's talk about a mistake that even pros make,
Okay.
trying to time the market.
Oh.
Graham was really clear about this.
Yeah.
It's pricing that matters, not timing.
Okay.
Trying to predict if the market's going up or down. That's just gambling, and the odds, they're not in your favor.
You know, it's funny you mentioned that.
Yeah.
One of these sources actually mentions Alan Greenspan.
Oh, yeah.
Back in 73.
Mm-hmm.
He was already like a big shot economist.
Right.
And he went public saying the market was going to crash.
Wow.
And what happened?
What?
It went way up.
Ah.
Soar.
Perfect example.
Yeah.
Even the smartest people can get it wrong.
Totally.
Because honestly, markets are affected by so many things.
Sure.
Economic data, global events, investor psychology.
And that's all connected.
It's like trying to predict the weather a year from now.
Yeah, that's impossible.
And there's that quote by that Danish philosopher.
Oh, Kierkegaard.
Yeah, him.
Life can only be understood backwards,
Right.
but it must be lived forwards.
Trying to time the market?
Yeah.
It's like trying to live life backwards.
You can look back,
Yeah.
but you can't see the future.
You can't know what's coming.
Right. So instead of timing the market,
The-
that Graham says to focus on,
On what we can control.
which is,
The price we pay.
okay, I see that.
Buy it right, and time takes care of itself.
Yeah, makes sense. But speaking of buying right, there's this whole thing with growth stocks.
Ah, yeah.
These companies that seem to just defy gravity.
Right.
How does that fit in with Graham's ideas?
He knew about the allure.
Okay.
He even used examples like Home Depot and Sun Microsystems back in the 90s.
Oh, wow. Yeah.
Companies growing super fast back then.
But there's got to be a catch, right?
You got it.
It can't
Yeah.
last forever.
He called it the law of financial gravity.
Okay.
He said the faster a company grows,
Mm-hmm.
the more expensive it gets,
Right.
and it's harder to keep up that growth.
It's like pushing a boulder uphill.
Exactly. Eventually, gravity wins.
And that's why we see these, high-flying stocks eventually come back down,
Right.
like all those .com companies.
Oh, yeah.
They were up, and then the bubble burst.
Exactly. And our sources, they have some crazy stats. Only a tiny, tiny fraction of Fortune 500 companies have managed to keep up high growth for like 20 years straight.
Wow.
So while it's tempting to go after those fast-growing companies,
Yeah.
remember, super fast growth, it's not the norm.
So what did Graham think about these growth stocks?
Mhm.
Did he say to just avoid them?
Not exactly.
Okay.
He actually said to get interested when things go wrong,
Oh,
like when bad news or a market dip brings the price down.
interesting.
He used the example of Johnson & Johnson back in 2002.
Yeah.
Their stock dropped 16% in one day
Wow.
because of some investigation.
So Graham didn't see that as a reason to sell. He
Yeah.
saw it as a chance to buy
A chance to buy a great company.
at a discount.
Exactly. Like waiting for a sale at your favorite store.
Oh, I like that.
You get the same quality, but for less.
Makes sense.
Now, this brings us to another interesting concept.
Okay.
Concentration versus diversification.
Yeah.
You know that saying, don't put all your eggs in one basket?
Oh, yeah, for sure.
That's the common advice.
Mm-hmm.
And Graham, he doesn't completely disagree,
Okay.
but he also brings up a different perspective. He talks about Andrew Carnegie.
The steel guy.
Yep, the one who said,
Put all your eggs in one basket
right.
and then watch that basket.
Carnegie was all about making concentrated bets.
Okay.
He believed in putting your resources into a few key investments,
Got it.
ones you really understand and believe in.
Makes sense.
And the source, it uses the Forbes 400 list as an example.
Interesting.
A lot of those people made their fortunes through big concentrated bets.
But isn't that, like, super risky?
That's the trade-off.
Okay.
High concentration, if you're right.
Yeah.
You can win big, but if you're wrong.
You lose big.
And what's fascinating
Right.
is that the source says very few people on that list
Okay.
actually kept their fortunes that way.
Over the long term.
Yeah.
It's like a high-stakes poker game.
Right.
You might win a hand,
Yeah.
but keeping those winnings over time.
It's-
So Graham acknowledged the potential of concentration,
He did.
but he ultimately was more for a balanced approach.
Yeah, exactly.
He knew people get attached to their investments,
Yeah.
and he warned against letting emotions cloud judgment. So you got to find that sweet spot.
You got it.
Conviction, but also being cautious.
Right.
Speaking of emotions,
Yeah.
there's this concept of Mr. Market.
Yeah.
What exactly is that?
Mr. Market is like this brilliant metaphor Graham came up with.
Okay.
Imagine you own a piece of a business.
Mm-hmm.
Every day, this guy, Mr. Market,
Okay.
he shows up at your door,
Right.
offering to buy or sell you more of that business.
based on...
his mood that day.
And his mood swings are pretty wild, I'm guessing.
Yeah, super wild.
Okay.
Some days he's super happy.
Oh, okay.
Thinks the business is worth a fortune.
Right.
Other days he's down in the dumps.
Oh, no.
Practically begging you to sell your shares for peanuts.
Wow.
The source even talks about Intuit back in 2000.
Oh, yeah.
The company was losing money.
Really?
But Mr. Market, he was so excited.
He didn't care.
He valued Intuit at $25 billion.
It's like he was living in a fantasy world.
Yeah. Mr. Market, he's driven by fear and greed.
Wow.
He's up and down, and that can create both, opportunities and problems for investors.
Got it.
The key, according to Graham,
Yeah.
is realizing you have the power to choose
To choose what?
whether to listen to him or not.
So don't let Mr. Market control your decisions.
Exactly. Don't get caught up in his emotional roller coaster.
Right.
You can look past all that and focus on the fundamentals,
Got it.
the businesses you actually own,
That's a huge advantage.
especially compared to professional investors,
Why?
because they often have to react to Mr. Market's every move.
That's crazy.
So us regular investors,
Yeah.
we might actually have an edge over the pros.
Just by staying calm
Exactly.
and rational.
That's the idea.
Wow. That's a real game changer.
So before we move on to bonds
Okay.
and the whole advisor thing, what's hitting home for you so far?
What's really sticking with me is that it's not enough to just know this stuff.
Right.
We got to actually do it.
For sure.
And part of that seems to be
Yeah,
getting a handle on your emotions,
absolutely.
not letting fear or greed, make your decisions for you.
Got it.
Investing is as much about psychology as it is about finance.
It's true.
Graham really understood that.
Yeah, he did.
He knew that the biggest roadblocks are often like our own biases
Right.
and emotions. So it kind of have to be our own therapist.
Yeah,
Learn to recognize our triggers,
absolutely.
develop some strategies for staying grounded.
Makes sense.
Speaking of staying grounded,
Yeah.
let's talk about bonds.
Okay.
They're usually seen as the safe part of a portfolio.
Right.
Keeps things steady when stocks are all over the place.
But even bonds have risks.
Really?
Yeah, one of the sources goes into that.
I've always thought of bonds as pretty simple. You lend money, they
Right.
pay you interest,
Right.
and then you get your money back eventually.
Yeah.
What's so risky about that?
Well, bonds are generally less risky than stocks,
Okay,
but they're not risk-free.
got it.
One of the main risks is interest rate risk.
Right?
Basically, when interest rates go up,
Yeah.
the value of your bonds can go down.
I'm not sure I get that.
Okay, imagine you buy a bond
Huh.
today.
Mm-hmm.
It pays you 3% interest.
Okay.
Now, let's say interest rates in general go up,
Okay.
and new bonds are paying 4%.
Got it.
Suddenly, your 3% bond doesn't look so good.
So to sell it,
Yeah,
you'd have to lower the price
exactly, to
So-
make it, competitive.
with those other bonds.
Right, and our source has this crazy example
Oh, really?
about a Northern Pacific Railway bond
Okay.
from way back in the early 1900s.
Wow.
It lost 2/3 of its value
Wow.
because of rising interest rates.
That's a big drop.
It shows you how much bond prices can swing.
Yeah, so no investment is totally risk-free. That's right.
And this is where diversification comes in.
Right.
Spreading your investments around.
Exactly.
And lower your overall risk.
You got it.
Okay, so we've covered a lot.
Wait.
Different types of investors,
Okay.
different types of investments,
Yep.
market timing,
Right.
managing risk,
It's a lot.
and the source talks about getting advice.
Oh, yeah.
I think that's something a lot of people struggle with.
That is.
Who should you listen to?
Great question.
When it comes to investing?
And the source really stresses
Okay.
the need to think for yourself,
Mm-hmm.
no matter who you're getting advice from.
Like, trust but verify.
Exactly. Especially in investing.
Oh, yeah.
There's always someone trying to sell you something.
Sure.
The source mentions brokers,
Okay.
financial advisors,
Right.
even like well-meaning family and friends
Oh, yeah, for
who
sure.
might give you advice you didn't ask for.
Yeah, it can be a lot.
So how do you cut through the noise?
Right. How do you know whose advice is actually good? The key is to understand the principles yourself.
Okay.
Educate yourself.
Mm-hmm.
Read books. Do your own research.
Right.
Make sure your investment strategy matches your knowledge,
Okay.
your risk tolerance, and your goals.
So don't just hand over control to someone else.
You got it.
Take charge of your own financial decisions.
Right.
And one practical tip from the source.
Yeah.
Use a bank as a middleman
Okay.
for things like delivering securities and making payments.
Right.
Why a bank?
Well, it mentions those recent brokerage house scandals.
Oh, right.
It's about, protecting your investments
Makes
and peace of mind.
especially with all the financial craziness lately.
It's a reminder that even institutions we think are solid can let us down.
Yeah, so be careful.
And be a little skeptical.
We've learned a lot from Benjamin Graham today.
Yeah, his stuff really holds up, doesn't it?
It's amazing how relevant his ideas still are,
It's true.
even though he wrote them decades ago.
What I find really cool
Yeah.
is that Graham wasn't just a great investor. He was also a really deep thinker about, like, human behavior.
Right.
He understood that investing,
Yeah.
it's about mastering our own emotions, our biases.
Yeah, totally.
As much as it's about analyzing, companies and markets.
That quote from Graham keeps coming to mind.
Which one?
The intelligent investor is a realist
Right.
who sells to optimists and buys from pessimists.
It really sums up his whole approach.
Yeah, it does.
It reminds us that to be successful,
Yeah.
you got to think differently, think independently.
Not follow the crowd
And stay calm.
when everyone else is freaking out.
Well said.
I think that's a great place to wrap up.
It is.
To our listeners, I hope you got some great insights today.
Me too.
And some new ideas.
Definitely.
Remember, investing, it's a journey, not a destination.
Keep learning.
Keep exploring.
For sure.
And most importantly, keep those emotions in check.